There is a story we are all taught before we ever learn how interest works. It's whispered by parents, repeated by grandparents, and shouted by smiling real estate agents on bus benches and billboards. The story goes like this: renting is throwing money away. You're paying someone else's mortgage instead of building your own wealth. Buying a home is the smartest financial decision you'll ever make. We absorb this narrative so deeply that it becomes part of our identity. By the time you're 30, still renting, there's a quiet voice in your head saying you're behind, that you missed a step, that you failed some invisible adulthood test. So people panic buy homes. They stretch their debt-to-income ratios. They accept 30-year obligations they barely understand. And they feel proud the moment they sign the deed, convinced they just made a responsible, grown-up investment. But here's the uncomfortable truth most people never hear. For millions of people in today's economy, that script is outdated. The math has changed, the market has changed, and blind faith in homeownership is quietly trapping an entire generation in a prison of illiquidity, stress, and stagnation. For many of you watching this, your house is not an asset. It's a liability wearing a very convincing disguise. It's a massive, leverage-fueled consumption purchase pretending to be an investment. And the real estate industry desperately hopes you never slow down enough to run the numbers yourself. If you feel pressure to buy, if you're house poor and wondering why you don't feel rich despite owning a home, or if you've ever thought, I did everything right, so why does this still feel hard? This video is for you, and if it helps you see housing differently, consider subscribing. Today, we're going to dismantle the rent versus buy myth piece by piece. We're going to expose the unrecoverable costs of homeownership, the money you throw away that is mathematically identical to rent. We're going to break down the price-to-rent ratio, the single most important metric most people have never heard of. And I'm going to show you how a disciplined renter who invests the difference can often end up with more wealth, more flexibility, and less stress than a homeowner chained to a 30-year mortgage. To understand why buying isn't automatically better, we need to redefine what throwing money away actually means. When you rent, you pay a monthly fee for a roof over your head. That money is gone. Everyone agrees on that. But when you buy a home, you're told your monthly payment is forced savings, that you're paying yourself, that it's equity. This is only partially true and especially false in the early years. A massive portion of what homeowners pay every month never comes back. It builds zero equity. It does not make you richer. These are called unrecoverable costs, and they are silent wealth killers. First, there's mortgage interest. In the early years of a 30-year loan, 70 to 80% of your payment goes straight to the bank. You're not paying yourself, you're renting money. Second, property taxes. A permanent rent paid to the government for the privilege of staying put. Third, maintenance. The unsexy expenses no one brags about. Roof repairs, water heaters. Plumbing surprises. Rule of thumb? 1 to 2% of the home's value every single year. Fourth, insurance. And finally, the massive transaction costs of buying and selling fees that can erase years of equity in a single afternoon. When you add all of this together, something unsettling appears. For many homes, the unrecoverable cost of owning is nearly identical to rent. You're not avoiding rent. You're just paying a different landlord. Now here's where the conversation usually breaks down. Because once people hear about interest, taxes, and maintenance, they say, okay, fine, but at least I'm building equity. And yes, you are, eventually, but whether buying makes sense or not usually comes down to one single number that almost nobody calculates. It's called the price-to-rent ratio. Think of it as the P/E ratio of housing. It tells you whether a home is cheap or expensive relative to the cost of living in it. The formula is simple. You take the price of the home and divide it by the annual rent of a comparable property. So if a house costs $500,000 and a similar place rents for $2,000 a month, or $24,000 a year, the price-to-rent ratio is just over 20. Historically, a ratio below 15 tends to favor buying. A ratio above 20 strongly favors renting. And here's the problem. In many major cities today, New York, San Francisco, Toronto, Sydney, that ratio isn't 20, it's 25-30, sometimes even higher. When the ratio gets that extreme, the math stops whispering and starts screaming. Because at those levels, you are paying an enormous premium to own the asset instead of rent the service. By renting, you're effectively living inside a very expensive asset for a fraction of the cost it takes to finance it. You're letting the landlord take on the leverage, the risk, and the headaches, while you consume housing at a discount. This flips the narrative completely. The renter isn't irresponsible. They're shorting the housing market. They're saying, I don't need to own this $1 million box. I just need to live in it. And here's where things get really uncomfortable. Because the most dangerous cost of buying a home isn't the mortgage payment. It's the down payment. That 20% you proudly put down? That $100,000 on a $500,000 home? That money is now trapped. It produces no income. It can't be rebalanced. It can't be redeployed. It can't help you if your life changes. It's dead equity. If that same $100,000 were invested in the stock market at a long-term average of 8 to 10%, it would mathematically double roughly every 7 to 9 years. By locking it into a single property, you're making a massive, concentrated bet that your local housing market will outperform diversified global markets. Historically, that's a losing bet. Nobel Prize-winning economist Robert Shiller showed that real home prices barely outperform inflation over long periods of time. The massive gains people talk about are usually leverage, inflation illusions, or luck in specific bubbles. Meanwhile, the disciplined renter takes that down payment, invests it, and continues investing the monthly difference between rent and ownership costs. This is called renting and investing the difference. And for people who actually stick to it, it's a wealth accelerant. Not because renting is magical, but because liquidity, diversification, and compounding beat pride and tradition every time. And we haven't even talked about mobility yet. Because your house isn't just a place to live. It's an anchor. Because here's the part of the equation that spreadsheets almost completely ignore. Liquidity, mobility, optionality. These aren't abstract concepts. They are financial assets. And in the modern economy, they are worth more than ever. Your house is not just a place to live. It is an anchor. When you buy, you are making a massive bet that your current location will be the best place for you for the next 7 to 10 years. Your job, your industry, your health, your relationships. The local economy, all of it has to go right for a long time. Because if something changes, the exit cost is brutal. Let's say you get a job offer in another city that pays $40,000 or $50,000 more per year. For a renter, this is easy math. You give notice. You pack up. You leave in 30 to 60 days. For a homeowner, it's a nightmare. You have to sell the house, pay 5 to 6% in agent commissions, pay closing costs, stage the home, hope the market isn't down, hope you don't have to sell at a loss. Those transaction costs alone can wipe out years of accumulated equity in a single afternoon. Buying doesn't just lock up your money. It locks up your future choices. In a rapidly changing economy, the ability to move quickly is a superpower. The renter can chase opportunity. The homeowner has to negotiate with it. And this is where the stability argument for homeownership starts to collapse. People buy houses because they want stability. But what they often get instead is anxiety. They become hyper-aware of interest rates, property taxes, insurance premiums, roof replacements, water heaters, foundation cracks. Homeownership is not passive. It's a part-time job you pay for. Weekends at Home Depot, evenings Googling contractors. That low-level background stress of knowing that when something breaks, you are the emergency fund. When you rent, you outsource that stress. If the dishwasher dies, you call a number. It gets fixed. Your mental bandwidth stays intact. And that time has value. Time to learn new skills. Time to take risks. Time to build side income. Time to rest instead of recover from constant responsibility. Ironically, renting often increases income potential because you're not distracted by managing a deteriorating physical asset. Now, there's one argument for buying that actually does hold water. And we need to be honest about it. Yes, but my mortgage is fixed. Rent keeps going up. This is true. A fixed-rate mortgage is a hedge against inflation. But here's what gets missed. Only the mortgage is fixed. Property taxes go up, insurance premiums are exploding. Maintenance costs rise with labor and material inflation. You are not immune to inflation as a homeowner. You are just exposed to it in different ways. Meanwhile, the renter's secret weapon is that stocks go up too. If you are renting and investing the difference, your portfolio is growing at 7 to 10% annually over long periods. Rent tends to rise at 2 to 3%. That gap matters. Your appreciating assets are paying for your lifestyle instead of your lifestyle being locked inside your asset. That's the inversion most people never see. And this leads us to the real question, the one nobody wants to ask. Are you buying a house because the math works? Or because the script told you to? Because once you strip away the emotion, the tradition, and the social pressure, you're left with a simple truth. A primary residence is a consumption choice, not a guaranteed investment. And if you treat consumption like an investment, you're going to be disappointed. Now, let me be very clear about something, because nuance matters here. I'm not saying you should never buy a house. That would be just as lazy and misleading as saying everyone should. Buying can make sense, but only under specific conditions. And the problem is that most people don't buy because those conditions exist. They buy because they're afraid of being left behind. Buying makes sense when three things are true. First, time. You are reasonably certain you'll stay in the same place for at least 7 to 10 years. Not I hope, not probably. But a high confidence commitment. Why? Because the first several years of homeownership are a financial dead zone. Your equity builds slowly. Your transaction costs are massive. If you sell too early, the math almost always works against you. Second, the price-to-rent ratio actually favors buying. Non-emotionally. Not culturally, mathematically. If the ratio in your area is below 15, buying deserves serious consideration. If it's above 20, renting is usually the rational move. And if it's pushing 25 or 30, buying is often a luxury purchase dressed up as responsibility. You don't get to override that math with vibes. Third, you value control more than liquidity. You want to renovate. You want permanence. You want to paint the walls, knock down rooms, build a garden, settle deeply. That's valid. But it's a lifestyle choice, not a wealth strategy. Where people get trapped is when they pretend these motivations are investments. Because here's the uncomfortable reality. For most homeowners, the house becomes their entire net worth. They are house rich and cash poor. All of their money is locked in one illiquid, undiversified asset tied to a single geographic area. If that neighborhood declines, if climate risk rises, if job opportunities shift, if the market corrects, they have nowhere to hide. Contrast that with the disciplined renter-investor. They have liquid capital. They can rebalance. They can move. They can adapt. They don't need permission from a bank or a buyer to change their life. And this is where the myth of forced savings collapses. Yes, paying a mortgage forces you to save equity. But forced savings only works if it's paired with good math. If you're forcing savings at a terrible price with huge opportunity cost, that's not discipline. That's financial self-harm disguised as maturity. If someone can only build wealth by trapping themselves in debt, the problem isn't renting, it's behavior. Renting isn't throwing money away. Renting is paying for flexibility. And flexibility is what allows intelligent people to exploit opportunity when it appears. A house doesn't make you wealthy. Owning income-producing assets does. Stocks, businesses, skills, systems, assets that pay you instead of assets you pay. Your primary residence will never send you a dividend. It will never compound. It will never work while you sleep. It will just sit there and demand maintenance. So here's the real framework. If you buy, do it because it fits your life, not because you think it's a shortcut to wealth. If you rent, do it intentionally and invest the difference aggressively. The worst position is the middle ground. Buying a house you can barely afford, in a market where the math doesn't work, while telling yourself it's an investment. That's not conservative. That's reckless. So let me leave you with the reframe that cuts through all the noise. The path to wealth is not about owning a deed. It's about owning options. Every financial decision you make either increases your flexibility or reduces it. It either gives you more control over your future, or locks you into a single outcome and hopes nothing goes wrong. When you buy a home without running the numbers, you're not being responsible. You're being obedient. You're following a cultural script written for a different economy, a different job market, and a different generation. And that script never asks the most important question. What is this costing me in opportunity? Because every dollar you tie up in a house is a dollar that can't move, can't compound efficiently, can't adapt when your life changes. That doesn't mean buying is wrong. It means buying blindly is dangerous. A house can be a wonderful place to live. It can be a source of pride, comfort, and stability. But it is not automatically a wealth-building tool. If you treat your primary residence as your main investment, you're creating a portfolio that is highly concentrated, extremely illiquid, geographically fragile, and vulnerable to forces you can't control: one natural disaster, one zoning change, one economic shift. And suddenly your safe asset doesn't feel so safe anymore. The real wealth game isn't about locking yourself into the biggest asset you can qualify for. It's about building income-producing systems that work whether you're awake or asleep. That's why disciplined renters who invest consistently often outperform homeowners who stretch themselves thin. Not because renting is superior, but because liquidity, diversification, and compounding beat tradition every single time. So don't let anyone shame you for renting. Don't let anyone pressure you into buying before the math makes sense. And don't confuse social approval with financial intelligence. Run the numbers. Calculate the price-to-rent ratio. Identify the unrecoverable costs. Understand the opportunity cost of your down payment. Then choose deliberately. If the math says buy, buy with confidence. If the math says rent, rent with pride. Because in the end, the goal isn't homeownership. The goal is freedom. Freedom to move. Freedom to adapt. Freedom to say no. And sometimes the fastest way to get there isn't through a front door you own. It's through one you're smart enough not to buy yet. If this video made you rethink what you've been told about housing, hit like. And if you want more breakdowns that challenge financial myths and show you the numbers behind the narratives, consider subscribing. I'll see you in the next one.